the market does want something. It wants profitable growth companies with stocks that trade at a reasonable price, not overly inflated by momentum. Now, that's often known by a shorthand. It's called growth at a reasonable price, or GARP. That's why all week I've been highlighting companies with faster than average growth rates and price to earnings multiples that are equal to or lower than those growth rates. On Monday, we covered the travel and restaurant plays. Tuesday was the underappreciated financials. Then last night, I talked about the GARPiest semiconductor companies and semiconductor capital equipment makers, a group that's suddenly gotten very out of favor, but now is GARP. Tonight, I've got one more group for you, and it's the industrials. We ran our growth at a reasonable price screen on the S&P 500. We got 51 results total, and we've been picking and choosing from those names to come up with these lists. Out of the 51 S&P stocks that passed the GARP test, 9 of them were industrials. So here we go. Now, not all these industrials are worth owning. Right off the bat, we saw 2 trucking companies, PACCAR and Cummins. These are trucking-related names. They're both fine companies, especially Cummins. I really like them. But I can't in good conscience at this moment recommend a play on truck manufacturing while we're seeing a lot of evidence to suggest the whole freight industry is experiencing a serious slowdown. Trucking rates are leading the way lower. That means PACCAR and Cummins will likely experience some nasty estimate cuts. So although their stocks certainly look cheap here, there's a very good chance they'll end up being more expensive once the numbers come down. Remember, it goes, the multiple is, when it's really low, what that really is signaling often is that the earnings estimates are going to be cut. Then we've got 2 more manufacturers with outsized exposure to housing. And they're both good companies, Stanley Black & Decker and Fortune Brands Home and Security. Just like trucks, though, I don't want to get behind anything housing-related right here, not with mortgage rates surging and likely heading even higher, which means the numbers there are probably too high. Again, when I say the numbers, I'm talking about the earnings estimates. That leaves us with 5 industrials that passed the growth at a reasonable price test. And they're very surprising, I think. General Electric, United Rentals, Howmet Aerospace, Textron, and one that I've really not liked for a long time, Johnson Controls.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.